Welcome back. Today we are finishing up, this is section 2. We are working on our income statement because for chapter 5 there's a brand new income statement that we must understand. So it's going to be about a two-parter. So let's get started. First one in this income statement, we always start off with our revenue. So in this case, we still have either sales revenue or service revenue. So we always start off with revenue. Then we minus out all of our sales expenses. So in our previous income statement that you guys have already learned, we have already talked about additional expenses that you would use for this month. Well, in a chapter 5 income statement, we're talking about buying and selling. We are talking specifically about all of the sales expenses. So there's multiple different kinds of sales expenses. The first one you could possibly have would be a promotion. And promotions are basically like 10 for 10 ads, buy one, get one free, 30, 50% off, clearance items are all part of a promotion. So you can easily have a promotional expense. You also could have slotting. Slotting, for most of you, some of you will deal with slotting. Slotting is a sales expense specifically that we may be subject to, specifically for products that are in beverage categories or specific placement in the store where you want it. So it would be a placement fee. 3, returns. So one of the big things that I didn't cover in our last episode was talking about the fact of returns. So you guys have experienced returns your entire life. Pretty much the fact of that if you're dissatisfied with the product, you could take it back to the retailer. And if you have a receipt, you get your full refund. And yes, there's other clauses and cases where if you don't have your receipt, you could still get a return. And get the money back. But returns can happen at any stage in that supply chain process. So it could have happened at the retailer. And the retailer, if it's a problem with the product being specifically defected, that the product would actually, that cost would be then pushed back to the manufacturer. If the manufacturer finds out that one of the subcomponents of that product is actually a defect as well, then they can easily pass that return onto the supplier. Now, specifically for quality control, they're supposed to catch that, but sometimes they don't. So returns can happen all the way far back through that entire process, all the way back to the supply chain or a supplier if need be, especially if there's a recall. That happens as well. So getting back to it, we have promotion, slotting, and returns. The last one we're going to talk about is allocations. Allocations is another way for new product development. It's an expense specifically to create additional funds for companies to launch a brand new product. So in order to drive their marketing and drive all of their other key initiatives to get communication out about new products specifically, they would use an allocation expense. So we at this point would total all of our sales expenses. So you would have total sales expense. So revenue minus your sales expense. Sorry, let me use a different color. Sales revenue minus our expense will give us our net sales. Now, net sales basically just means the fact that this is how much money that we have left over for our business, excluding all of the sales expenses it costs us in order to receive our money. Next one is going to be known as cost of goods sold. I'm going to do that in orange. So from net sales, then we subtract out our cost of goods sold, COGS, COGS, right? Cost of goods sold. The reason for this is we're going to get back to this. This cost of goods sold is actually for manufacturing. If you guys are AMM students and we're referring to that you're selling products from a boutique store, and let's say, or even if you're not AMM, let's say that you go to the store, you bought a bunch of cookies and you decided to resell them specifically, the cost of goods sold is the amount of money that it costs you to buy that product, right? And all you're doing is you're putting a profit margin on top of that in order to receive additional revenue for the products that you purchased. So I'm going to come back to cost of goods sold in our next part of the lecture to go over cost accounting specifically, because the cost of goods sold is the total price of a good that you're planning on selling it for. Okay, so I'll get back to that. You don't need to memorize that, but you do about cost accounting, but you do need to memorize this entire income statement. So it is a bit longer. Next stage is after we subtract out our cost of goods sold. It's called gross profit. Gross profit is another number that we recognize. Now, gross profit, what that basically means is this is our true amount of money of profit that we receive in order to pay all of our bills. So from here on out, after gross profit, then we subtract all expenses, okay? Just like we did in chapter 1. All these expenses would be, anything that says the word expense would be with what we paid for that month. It could be rent expense. It could be rent expense. It could be cell phone expense. It could be all these other kinds of generic expenses. When you subtract when you take gross profit and subtract it by all expenses, you get this thing called EBITDA. E-B-I-T-A, okay? What it basically stands is for earnings before interest and taxes. Just know you have to subtract this for this sum of money. Second to last part now is we're going to subtract out for taxes. So minus your sales, so minus taxes. And normally for most taxes, for most businesses, now I'm not referring to sales tax here. This is referring to federal and state government taxes. We normally take out about 25% for taxes. It's usually about 20 to 25%. Let's just do 25% specifically to kind of help. Okay, so we're going to minus taxes out of our EBITDA. So if you can't see this, move this over here. EBITDA minus taxes gives us our net income. Okay, this is the new chapter 5 income statement you're going to have to remember. The reason for that is because there are two major ratios that you're going to know. But in order to calculate for those ratios, you need to know net sales and you need to know gross profit. These two are the biggest ones that we look at specifically from a business standpoint to see if we're making enough money on our products overall. It also helps us to determine the entire company's profit margin, as well as if we're to make sure that if we're healthy enough for growth, so we can earn additional money for working capital moving forward. All right, I'm going to pause this because now we're going to break into the cost of goods sold a bit more into cost accounting. So bear with me.